Before we begin our investigation, a quick reminder. All information in this video is for educational purposes only and is not financial advice. January 1st, 2026, while the world sleeps off its New Year's celebrations, a tectonic shift is occurring behind the scenes of the financial system. The price of silver has fractured. On your broker's screen, if it's even working, you see a frozen number, $77. But if you try to buy a single silver coin in the real world, you will either be refused or you will be quoted a price of $128. What on earth happened overnight? You are on New Era Economics, and this is not a forecast. Subscribe to learn more. Our investigation is just getting started. This is a chronicle of the first day of the collapse. In our last video, we predicted that on January 2nd, the silver market might not open as we knew it. Today, I will show you why that prediction has already become a reality. While the world was celebrating, a series of events occurred that has permanently severed the global silver supply chain. This is no longer a theory. These are facts recorded over the last 24 hours. I am not going to tell you what will happen. I am going to show you what has already happened. 4 shocking facts that represent the death throes of the old financial system. And a 5th fact about how this will personally affect you. What you are about to see is a detailed chronicle of why tomorrow's opening bell is merely a formality before the market's death is officially declared. So, fact number 1, the official price is dead. The number you see on the screen, $77, is a zombie price. It exists, but it has no connection to reality. While the COMEX is frozen, the real street market has erupted in an act of open rebellion. My investigation this morning began with checking the largest precious metal dealers in the United States. The picture is the same everywhere. APMEX, JM Bullion, and the other retail giants have completely changed the rules. They are no longer looking at the COMEX price. The price for the most popular investment coin, the American Silver Eagle, on their websites is fluctuating between $115 and $128. This creates a historic, unthinkable gap with the official exchange price of nearly 65%. Let me say that again. 65%. A spread like this didn't even happen during the Hunt Brothers panic in 1980. This means that the retail dealers, the ones on the front lines who feel the real pulse of supply and demand, are publicly declaring that the price being broadcast out of New York is a lie. But this isn't just America. In London, my sources report, jewelers and small industrial players are making private over-the-counter deals for scrap silver based on a price exceeding $100. The market has gone underground. It no longer trusts the centralized exchanges. Like a living organism, it is trying to find a new, real price in the face of a total, overnight deficit. The first fact is undeniable. The street has declared war on the exchange. And judging by the price gap, the street is winning. So the street price of silver has decoupled from the official one. But why? Why are dealers who were selling coins for $70 yesterday now asking for $128? Is it just greed? My investigation shows that it is not. The reason is far more terrifying. They have hiked their prices because they themselves have received Dear John letters from their suppliers. This brings us to the second shocking fact. The world's largest commodity traders are declaring force majeure on a massive scale. What is force majeure? In the world of big contracts, it's the eject button. It is a legal mechanism that allows a company to state something unforeseen and uncontrollable has happened. Therefore, we cannot fulfill our obligation to deliver the goods. And this morning, as I've discovered, giants like Glencore and Trafigura, the very companies that act as the circulatory system of global raw material trade, began officially notifying their industrial clients of force majeure on silver deliveries. In these notices, they cite insurmountable governmental export restrictions from key suppliers. They are, in essence, admitting that their own supply chain has been severed. The spigot from which they source the metal has been turned off. But why can't they just find a replacement? Why not buy silver from Mexico, Peru, or Poland, other major producing nations? The answer was short and chilling. There is nothing to replace it with. It turns out that all the available metal scheduled to be produced in these countries has already been sold off via long-term contracts for the next 12-18 months. It hasn't even been mined yet, but it already belongs to the industrial giants who, as we've discussed in past videos, have been panic buying physical supply by signing direct deals with the mines. Think about what this means. The retail dealers can't get metal from the wholesalers. The wholesalers can't get metal from the commodity traders like Glencore. And Glencore can't get metal from the producing nations. The supply chain is broken, and it's not broken at the level of the corner store. It is broken at the highest corporate level. The news that Glencore, a company with hundreds of billions in revenue, cannot source a few tons of silver is the financial equivalent of being told the oceans have suddenly run dry. It is an event that was not supposed to happen, and it proves that the deficit has moved from a theoretical concept into a brutal, physical reality. Insurmountable governmental restrictions. That phrase from the force majeure notices became the key to my further investigation. What restrictions exactly? By which government? And here we arrive at the third, and most important fact, the root cause of all this chaos, which until now has gone unnoticed. On the night of January 1st, China, in effect, dropped a silver curtain. The Chinese Ministry of Commerce quietly activated Directive 2026-1. On paper, it looked like a boring, bureaucratic update to export regulations. But when I studied the details, I realized these are not just restrictions. This is a de facto, meticulously designed embargo. Here are the new barriers that have been erected. Now, to export any batch of 99.9% pure silver from China, one requires, first, a Category A license. As I was able to find out, only 8 state-owned refineries hold such licenses. All private exporters have been cut off from the world market with the stroke of a pen. Second, a mandatory end-user certificate. This is the most crucial part. China now demands to know not just which country the metal is going to, but which specific factory it will be delivered to. And if that factory is on a list of companies related to the industry of the US or Europe, the export is automatically denied, restricting its use to China's domestic production only. This is a brilliant and ruthless move. China, which refines approximately 60% of all the world's silver, including ore imported from other countries, has just hit the stop button. They haven't just banned exports. They have taken full control over who in the world will be allowed to receive this strategic metal. This brings us to the mathematics of the collapse. The blockade of Chinese refining instantly creates a hole in global supply of over 400 million ounces a year. The rest of the world operating at maximum capacity can replace 330 million at best. This means that right now, as of January 1st, the world is not just facing a deficit. It is facing a black hole, an immediate annual shortfall of 70 to 120 million ounces that cannot be filled. These aren't just numbers in a report. This means that in 14 days, the assembly lines at Apple, Tesla, and Samsung could simply run out of a key component. And now we understand why Glencore is declaring force majeure, why the dealers are in a panic, why the price in Shanghai has gone stratospheric. They were the first to realize the consequences, and the shockwaves from this decision are only just beginning to ripple through the global economy. A price rebellion on the street, corporate force majeures, a Chinese embargo. All of this brings us to the fourth fact, to what will happen when trading opens in New York tomorrow morning on January 2nd. This is no longer a question of if, but of how exactly it will happen. And my investigation, based on market mechanics, paints a picture of an inevitable programmed collapse. When the opening bell rings, the computer algorithms of the largest banks and funds will be confronted with 3 undeniable facts that did not exist a week ago. The price of physical metal in the East is $12 higher. The world's largest supplier of refined silver has exited the game. The inventories in their own warehouses, the COMEX, are approaching zero. The reaction will be instant and automatic. The price will not open at $77. It will gap up, instantly jumping to try and catch up with the street price and somehow reflect the new reality. I expect the very first print to be at $90 or higher. In that same second, the automatic circuit breakers on the exchange will trigger. Trading will be immediately halted due to hitting the maximum daily price move limit up. The exchange will try to create the illusion of control, giving the market time to cool down. But there will be nothing to cool down. This pause will be followed by an avalanche of margin calls. Every fund, every bank that was betting on a lower price, holding a short position, will be technically bankrupt at that moment. Their losses will exceed all of their collateral. The exchange will demand they immediately post billions of dollars that they do not have. A chain reaction of defaults will begin. The exchange will try to create a semblance of order. Perhaps they will keep trading halted for several hours. Perhaps they will announce an investigation. But it will be too late. The physical market that we've been analyzing, the dealer market, the Dubai market, the London market, will already be living in its own reality. It will already be trading at $130 an ounce, completely ignoring the frozen fictitious price on the COMEX. Welcome to a world where silver has 2 prices, the price of the real world and the price of a dying paper casino. The collapse on the exchange is no longer a forecast. It is the mathematical consequence of the facts that have already occurred. On January 2nd, we will merely be watching as the domino that has already been pushed completes its fall. But a trading halt on the exchange is not the finale. It is only the beginning. And the fifth and final fact of this collapse is how this broken supply chain will personally impact you and change the rules of the game forever. My investigation shows there will be 3 impacts, and they will affect everyone. The first impact is on your paper assets. I'm talking about the illusion of wealth. Your brokerage account might be showing record profits from shares of silver mining companies or ETFs. But when the exchange halts trading and the dealers declare force majeure, you suddenly realize you don't own silver. You own a digital promise from a company that is itself on the verge of bankruptcy. The first impact is the realization that your on-screen wealth can turn to dust, because there was a chain of intermediaries standing between you and the real asset, and that chain has just been broken. The second impact is on the store shelves, the domino effect in the real world. Silver isn't just coins, it is the lifeblood of modern technology. A 400 million ounce hole in the global market is not a hole in a bank's balance sheet. In a few months, it will be a hole on the store shelves. The second impact is when you realize that the new smartphone, the solar panel, or even some vital medical devices have become scarce or have tripled in price. The collapse in the silver market is the beginning of a supply collapse for the entire high-tech economy. And the third and most important impact is on the very idea of money. And this brings us to the new rule of the game. The old paradigm, where the goal was to sell an asset for dollars, ceases to function. When the official price is a lie and dollars are rapidly losing value due to panic and emergency liquidity injections, a new primary question arises. What can I exchange my ounce of silver for? For food? For fuel? For services? You will realize that your physical silver is not just an investment for profit. It is an insurance policy and a tool of direct exchange in a world with broken supply chains. Conclusion. So, there they are, the 5 signals. A street price rebellion, corporate force majeures, the Chinese kill switch, the coming exchange collapse, and finally, the inevitable impact on your savings and your way of life. The chain is broken, and in a world with broken supply chains, the only thing that matters is what you can hold in your hand. If this investigation has helped you piece together the puzzle of events unfolding behind the holiday curtain, subscribe. We are only just beginning to understand the rules of survival in this new, emerging reality. Thank you for watching, and I'll see you in the next video.